Welcome to today's webinar on manufacturing conditions. I'm Haley Shenander of the Federal Reserve Bank of Minneapolis. Before I turn it over to our speaker today, I have a few housekeeping items. Slides for this presentation and a copy of the video link will be emailed to all registered attendees next week. Joe will be entertaining questions at the end of his presentation. If you have a question, please type it in the chat box on Zoom. We'd love to get your feedback at the end of this presentation, so please take a moment to fill out the brief 3-question survey that pops up in your Zoom window when you exit the webinar. And with that, I'll turn it over to Joe.
All right, thank you, Haley, and thank you to everyone in our audience for joining us today. I'll be going over the results of our annual survey of manufacturing conditions that we do in conjunction with our partners at the Minnesota Department of Employment and Economic Development this morning. I'll start by giving a little bit of high-level detail about the role that manufacturing plays in our regional economy. But before I get into the content, just want to get my standard disclaimer out of the way that my opinions are my own. I'll try actually not to share any of my opinions, but if I do, I just want you to keep in mind that those opinions are mine and not necessarily the Minneapolis Fed's or the Federal Reserve System's opinion. So just a quick overview of what I'll be talking about. I'm going to get into some detail about the manufacturing sector and its role in our district economy before I get into our survey results. Not to keep you in suspense, I'll just kind of give you some quick headlines. Survey results were somewhat pessimistic looking backward over 2023. This is somewhat surprising given the overall growth in the economy that we saw throughout 2023, both in employment and in output. The manufacturing survey respondents told us that their activity actually declined slightly on balance in 2023, but with some qualifications that I'll get into once I go through the results. Despite that, the outlook for 2024 is relatively positive. They're expecting a rebound in activity growth relative to 2023. So positive outlook for manufacturing. Their overall economic outlooks are somewhat pessimistic for 2024. So sort of the inverse of what we saw last year, where we saw growth in the economy, manufacturers saw a decline in activity. They're expecting their own businesses to grow, but the economy to decline slightly. Although, of course, they have better information about their own businesses than they do necessarily about the overall economy. And then one quick finding I'll be going over on the results of higher interest rates and the impact that that's having on the sector. And manufacturers did tell us, in fact, that the higher interest rate environment is constraining activity, and they expect it to be constraining activity going forward. We also asked a question about the role of artificial intelligence and whether folks are using that. Not a lot of uptake of artificial intelligence, but I'll get into some of the details on that in a moment. So just a quick bit of background on manufacturing's role in the region. Often in these presentations, I would start by presenting a map of the Federal Reserve's 9th district. So we at the Minneapolis Fed are responsible for overseeing part of the country that's the north central United States. Our district includes the states of Minnesota, North Dakota, South Dakota, Montana, and we have portions of Wisconsin, the northwest portion of Wisconsin, and the upper peninsula of Michigan. A lot of folks that are in the audience today have probably joined us for previous webinars, so you're probably familiar with our regional economic geography, but it's useful to go over that because I'll be referring to the 9th district a lot. And so these results cover the 9th district. A lot of it I'll show you in a moment is going to be for Minnesota, but for some of the other states in our district as well, they're all represented in our survey. And what you can see here, I just think it's useful to break down the size of the manufacturing sector in our economy relative to the US economy as a whole. And what you can see is that when you look in terms of GDP, that's what I'm calling output here, that's an attempt to measure the value of goods and services that the economy produces in a given year. We don't actually have final GDP at a regional level for 2023 yet. But if you look at the end of 2022, manufacturing was a larger share of what we produced in the 9th Federal Reserve District than it was in the US. So it accounted for about 11% of US GDP, but 14% of the GDP for the states in the 9th District. If you look at employment, so I was just showing you a moment ago the measure of the value of what we produce. But if you look at where people are working, folks working in factories are also a larger share of the labor force in the 9th District than they are in the US. And I should qualify, I said people working in factories, but manufacturing, the sector also includes people working for firms that are involved in manufacturing, maybe if they're on the administrative side. So you can see here that it actually, as a share of employment, manufacturing is a larger share of where people work in the Ninth Federal Reserve District, and it's even more large relatively than as a share of output. So 12% of the labor force versus 8% for the U.S. It's a pretty important part of our economy, and of course, there are a lot of supporting industries as well that use the outputs of manufacturing and that provide services or inputs to manufacturing as well. But these are just people working for manufacturing firms. So I think it's useful to kind of go over how large of a role manufacturing plays. I think in the popular imagination, people think often that manufacturing has become a smaller part of our economy than it used to be. There's actually the value of what we produce in manufacturing in the U.S. is larger than it ever has been, but as a share of the workforce, it has been trending down over time because it takes fewer people to produce the same amount of goods. So that's just a little bit of background on the size of the manufacturing sector before we get into the results, and I just think it's useful to kind of put those in context. So again, getting into the survey results. This is a survey that we do on an annual basis. I want to thank our partners at the Minnesota Department of Employment and Economic Development. They help us conduct the survey. The way that we break it down is they conduct the survey for Minnesota, and they release results that are just for Minnesota, and you'll be able to find those on their website. They should be releasing their results today, just as we are. We take their results for Minnesota and then combine them with the survey results that we conduct for the other states in the Ninth Federal Reserve District. And those are what I'll be sharing with you this morning. So for the region as a whole, including Minnesota, but also for other states as well. We conduct this survey on an annual basis. It follows the principles of sound survey design, in as much as we take a random sample from a large database of manufacturing locations. That sample is stratified by firm size and by state, so that we're getting a representative sample of firms in our region. And we actually conduct this survey by mail. So we mail out survey forms to a lot of addresses. We get them back and actually tabulate them by, well, we don't tabulate them by hand, but we do have to transfer those data to electronic before we tabulate the results. So it's a large survey. We ended up with 426 respondents this year, so pretty good size. And this was actually a larger response than we've gotten over the last few years. So we got a pretty nice turnout from our survey respondents this year. And again, if you're interested in some of the details of what I'll be going over, the survey article should be going up on our website at minneapolisfed.org later this morning. So that's a little bit of background on what the survey is. Just give you a little bit more context on who is taking the survey here. We ask a demographic question about the ownership of these firms. You can see that there's a small share of them that are minority owned, just about 5% across the district, slightly larger share that are veteran owned, and a little bit more than around 13% that are owned by women. And you can see that the majority of the survey respondents said that they were none of the above. So that gives you kind of a little bit of, sort of the representation of firms of different ownership, those that are minority and women-owned business enterprises, just to kind of put that in a little bit of context. And in terms of geographic representation, I think it's useful to break down the respondents. So you can see the majority of the survey respondents that we got were from Minnesota. That's sort of not surprising if you look at the concentration of firms in the district, and in particular, the size of the state's economies relative to each other. So we have largest representation from Minnesota. It's interesting that the next largest is Wisconsin, and that's sort of a reflection of the relatively larger role that manufacturing plays in Wisconsin's economy, because we actually don't represent all of Wisconsin, and we only do a survey for those portions of Wisconsin that we represent, Northwest Wisconsin. So even though we're not covering the whole state, we get a pretty large turnout from Wisconsin because there's a large representation of manufacturers in Wisconsin. Michigan, I should point out, is the smallest state in the sample. It's important to mention that the Ninth Federal Reserve District only covers the Upper Peninsula of Michigan. Michigan, of course, is heavily concentrated in manufacturing, but a lot of that activity is in the Lower Peninsula of Michigan, which is in the Chicago Feds District. So that's the smallest share, and you can see where the other states break down as a share of respondents. So that'll give you kind of an idea where these folks are coming from. A little bit more than half, 60% of them roughly, are from Minnesota, and then the others are from the other states in our district. So to get into the survey results themselves, as I mentioned at the outset, overall, the respondents in our survey told us that their activity decreased in 2023 for almost all of the indicators that we ask about. So I'm summarizing survey results here in an index number that's referred to as a diffusion index. The way we actually ask about the question was, for example, for employment at your firm, did your employment increase, did it decrease, or did you leave it unchanged over the past year? And we kind of average or sum up those numbers in something called a diffusion index. And you can see values, as the note indicates, values above 50 in the diffusion index indicate that on balance, the respondents told us that that indicator increased. Values below 50 tell us that on balance, they decreased. And it's important to point out that there's a lot of heterogeneity underlying these summary numbers. So while on average, a lot of these indicators are down, there's quite a bit of diversity among the respondents themselves. So just to kind of give you a little bit more details, and again, if you go to our website later this morning when this survey is published, you'll be able to find the actual table of results on there. I'm just kind of summarizing them in this nice chart here. So for the number of orders, that's kind of an attempt to measure the overall level of demand. About 50% of respondents told us that their number of orders was down in 2023. Now, it's important to point out that in 2021 and 2022, we saw sort of a boom in manufacturing. So the vast majority of respondents were telling us that orders increased. In fact, they were telling us that they were having a hard time keeping up with orders. So this is a decrease from a relatively high period. It's important to put that in context. And still, 29% of respondents told us that their number of orders increased. And that's sort of the case for a lot of these other indicators as well. So for example, production, half of the respondents told us that there was no change in production at all, that their output was roughly the same as a year before. And that's true for employment as well. So for a lot of these indicators, the respondents told us that there was just no change, but there were slightly higher portions of respondents who told us that they decreased rather than increased, and that's why you see that on balance we have these results that there was a net decrease in activity in 2023. And so again, going across the board, you can see that most of them decreased. There was a slight increase on balance in investment in plant and equipment or capital expenditures. That's the only sort of business related indicator that increased, and then selling prices as well. That's consistent with what we know about what happened with inflation over the last couple of years. A strong majority of firms told us that they increased the prices that they charge to their customers. 60%, in fact, said that their selling prices went up. You can see profits are down. And that's sort of an indicator you can maybe read into that on balance, even though the selling prices and revenue might have gone up, that was outweighed by the decrease in orders and probably an increase in input costs. And on net, that ended up eating into profits. Get more detail on our website if you want to get into the breakdown of the survey results. Just to put these in sort of historical context, this is again that diffusion index number, just that net increase decrease on average. And you can see how this is broken down for a few of these sort of key indicators over the life of the survey. We've been doing this survey for nearly 20 years now. And you can see that, in the last year, we dipped into contraction territory, but we had 2 pretty strong years of growth prior to that. So that's sort of where last year comes in relative to the history of the survey. And you can kind of see if you look at over time at the periods where the survey dipped, those tend to coincide with often with recessions or with contractions in the economy. Not always, though. If you go back to 2016, 2015, the survey respondents were a little bit pessimistic on balance for what they saw happen to their business, and then there was a period of growth following that. And indeed, we ask about expectations for the coming year, and the firms that we surveyed are expecting their business to rebound on balance in the coming year. Again, a lot of heterogeneity underlying this summary number that I'm reporting to you. So again, you can look at the breakdown of survey respondents on our website. But again, if you look at what they told us here, and here's what I'm representing on this chart, their expectations for 2024. So on the survey, we asked them what happened in 2023 at your firm and what you think is going to happen in 2024. So this is a best guess. We like to think that these are folks who understand their businesses fairly well, and they probably have a pretty good idea what to expect for the coming year. But of course, there are things that nobody can forecast that are going to affect what actually ends up transpiring. But in terms of their outlook for the coming year, they're expecting growth. So I qualified the 2023 results by saying that this was a decrease coming off of a period of strong growth. Now we have a period of decrease in 2023 of contraction, and the firms are telling us that they're expecting growth in the coming year. So again, I would characterize this as maybe a rebound rather than an expansion, just based on the results of the survey. And you can see that they're all sort of mildly above that threshold of expansion, indicating that there was just a higher percentage expecting growth in the coming year than expecting further contraction in the coming year. So you can see again across the indicators, we have expectations calling for an increase in demand if you go by the number of orders, and an output and employment as well. Labor availability still expected to be negative in the coming year, although not as bad as what we saw over the past year. And if you go back into the history of the survey results and previous releases for labor availability, that level was coming in much lower. So there is some indications of improvement, but still an expectation that labor availability is going to continue to get worse in the next year. And that's consistent with what we're seeing in the macroeconomic data and with their expectations for higher employment in the sector over the coming year. Still is some increase for inflation, but at a lower rate if you just go by the average in the diffusion index over the coming year. So expectations on net for growth in prices, but a smaller share expecting to increase their prices over the coming year than last year. Profit expectations are still negative, but productivity is positive. So overall, we're looking at expectations for a rebound for further growth in 2024. Again, just to kind of put that in historical context, where is their optimism level for the coming year relative to where it usually comes in? You can see if you look at the survey, history, on balance, they tend to err on the side of optimism, even in periods of contraction, like in 2020, 2021, when we were experiencing the pandemic. When in 2020, when we surveyed them at the end of the year, not surprisingly, most of them told us it was a bad year and they saw activity decrease, but they had positive outlooks for 2021. So they tend to err on the side of optimism for their own businesses. It's important to point out that all the results I've been sharing with you so far are their experiences or expectations for their own firms rather than their overall expectations for the economy. And so you can see that while they're optimistic for the coming year, the share of them that are optimistic is declining. So they're just slightly balancing on the optimism side of expectations for the coming year. And you can see coming off of the last couple of years where expectations were pretty strong, that's trending downward, but again, still in a positive direction. And that's kind of what I want to underscore here. When you turn to their overall economic expectations, and again, as I just mentioned, all of the results in the survey so far were referencing their own experiences, their own expectations for their firms. But we also asked them, what do you expect to happen in your state economy over the coming year? And those are pessimistic for the year forward. And here I'm comparing not to what happened in the past year, but to what the expectations were when we did the survey a year ago, which is, I think, a more interesting comparison to make, in part because we know what the data actually say about what happened in the overall economy and even to some extent in the manufacturing sector over the last year. But at this time last year, or rather in November and December of 2022, when we surveyed them, they were expecting contraction in their state economies over the coming year. Of course, we know from the data that we have available to us that state economies continued growing over the course of 2023, both in employment and in output. They were correct in their expectations for inflation, at least in as much as we still saw elevated inflation over 2023, although inflation has trended down in terms of the rate of increase in prices. So that's just to take these results with a little bit of a grain of salt. I think this is more sort of a check on the mood of manufacturers in terms of their overall economic outlooks. And those are pessimistic on balance for the coming year. You can see they're all sort of below 50 again, except for the outlook for inflation. Happy to entertain more questions about that if we have time at the end of the presentation. Before we get to the sort of Q&A portion, open portion of the presentation, I do want to go through the results of a couple of special questions that we asked. So we often ask a question about credit conditions on the survey, essentially Are you having and are you able to obtain adequate credit? Is it affecting your business? This year, we wanted to focus a little bit more specifically on interest rates because the interest rate environment has, of course, gotten more constraining. Monetary policy has tightened over the last couple of years and interest rates are higher. So we wanted to know a little bit more about how that's affecting these firms. And you can see that on balance, most of these firms told us that interest rates were having a constraining effect. Although you can see a large share of them telling us that their expectations for how rates would affect their business in 2024 were essentially unchanged. So again, just kind of going through on an indicator by indicator basis. A large share of firms told us that nearly half of firms, in fact, just under half of firms told us that they were expecting that interest rates would have a negative impact on their capital investment in the coming year. Not surprising, it's more expensive to finance capital investment. In fact, we had some comments in the comment form on the survey telling us that they were planning on increasing capital investment, but they were going to do it with cash. They weren't going to borrow to do it, which is consistent with a higher interest rate environment. The only thing that, and perhaps surprisingly so, had a large share of respondents telling us that they expected it would increase in light of the interest rate outlook for 2024 was their pricing to customers. Sort of surprising given that we expect higher interest rates to have a deflationary effect on the economy, but I think overwhelmingly folks are still sort of experiencing the inflationary environment. That's me putting a little bit of interpretation on the response to the question. We don't really know exactly why they say they give the answers that they do, but you can see a large share of them telling us that they're still planning to increase prices in 2024 despite the tighter interest rate environment. One more thing that I want to share with you before we get into the Q&A portion and wrap up is a special question we asked about uptake of artificial intelligence. We've heard anecdotally that a lot of manufacturers are starting to use more machine learning and other technologies to try and improve operations or find efficiencies, even to enhance automation given the tight labor environment. So we asked about whether folks were or were not using AI in their firms or were considering it, and the reasons why. And you can kind of see the breakdown here. Again, overwhelming majority. I should point out, by the way, that this question was sort of a check all that apply question. So these percentages don't add up to 100 because people could check multiple responses. Overwhelmingly, the largest share of respondents told us that no, they're not using AI just because they don't have any of the systems or tools in place. We did receive a lot of comments about folks saying they simply don't know enough about it. Just under 15% of the firms telling us that they don't quite trust AI. They're a little bit leery about it. And then a lot of folks saying it's too expensive. You can see the composition among those respondents that were making use of AI. Each of the yes responses, they tallied under 10%. So they're a small minority of firms. Even if you were to add them all up, still a minority of firms. The largest share, though, I think interestingly, was people saying that they are using AI to enhance human-robot operations. And then you can see a few of them saying that they're using it for product development or for logistics management, things of that nature. But again, the largest share are telling us that they're not using it for one reason or another. And with that, that's kind of the overview of the survey results. I want to thank you all for listening. I think we have a few minutes here to entertain questions. And Haley, do we have any questions that have come in through the chat?
Yeah, and just as a reminder, if you have questions, please type them in the chat box on Zoom. So let's start with this one. The limited uptake in AI also seems inconsistent with low labor availability, since you might think firms would be investing in automation or other technological solutions. Why aren't more manufacturers turning to AI?
So that's a good question, and that's a big part of the reason why we asked about this, because in previous years, we've asked about use of automation specifically. We had a fairly large share of respondents tell us that, in fact, they were investing in automating due to a tight labor environment. So we thought that that would be interesting to ask about AI in part for the same reason. And so it's surprising in a way that more firms aren't telling us that they're making use of these technologies. Now, obviously, these are new technologies. They haven't been available to manufacturers for that long. I do think it's worth pointing out that, as I mentioned earlier, the largest share of respondents that are using AI told us that they're doing it to enhance human robot operations, which I think you would take to be a way of getting sort of wringing more productivity out of automation. And I would guess that most of the firms that ticked that are investing in those types of AI because of the tight labor market environment, because labor has gotten more expensive, and they're looking at that trade-off and thinking about investing more in automation and other ways that can make it possible for their human employees to do more with less. The important thing about manufacturing, though, is, as always, even though it's gotten more technologically sophisticated, more productive, and as I mentioned at the outset, we're producing more as a nation and as a region in our manufacturing sector with fewer employees. It still takes people. And so I think that's always going to be the case. And I think that's part of the reason why we've maybe seen slower uptake of AI, certainly, than we're starting to see in some of the service sectors, for example.
Great. Thanks, Joe. Someone else was wondering, when you asked respondents about the outlook on their state economies, did you see any specific differences among outlooks by state?
You know, not really. And honestly, I don't want to overcharacterize the divergence in economic views by states, simply because I don't like to break down the state by state responses in kind of granular detail, just because even though this is a high quality survey and we conduct a large sample across our region, the state by state representation is smaller by nature than the overall survey results. And so by looking at the individual state level responses, you just get more statistical error that gets introduced into the results. And so I don't spend a lot of time breaking down the state by state results. Anecdotally, it did seem to be the case that the Minnesota manufacturers were a little less optimistic on balance for their state economies than some of the other states in the region, and you can see that, I think, if you look at the Minnesota Department of Employment and Economic Development's release later this morning. But it's a small difference. I think that overwhelmingly it's more similar than it is different.
Yeah, for sure. Someone else was wondering earlier on in the presentation, and it's more of a technical question, but do medical devices fall within the manufacturing sector?
Yes, they do. And I anticipate that you're asking that because we are all aware that in Minnesota's economy, medical devices are pretty large, an important part of our economy. We can certainly think of a few really prominent firms that are in the medical device sector in our state. And yes, indeed, medical devices are included in the manufacturing sector, even though you might think of them as being healthcare related, but because it's actually the production of a good, it's classified as manufacturing.
Great. And then it looks like we have time for just one more question. Someone was wondering, the survey findings show that labor availability has gotten worse. It seems to conflict with the reports and data that indicate labor tightness has eased recently. What do you think accounts for the difference?
Yeah, and if you look at actually our most recent beige book that we just released a couple weeks ago, the Minneapolis Fed reported that we've seen some improvement in labor availability in our district. I think there's a couple. I think that the inconsistency is not as large as it might appear. One of the reasons is that we're asking them to make a year-over-year comparison. So they're comparing December 2023 versus December 2022, and they're telling us that labor availability is worse now than it was a year ago. So on an annual basis, that could be true, even if things have gotten a little bit better over the last few months. So I think that's probably the overwhelming reason. Now, it could be also that that labor availability is just worse in the manufacturing sector. Certainly, anecdotally, we hear about difficulties hiring workers in all of the industries that we speak to, but manufacturing is and has been for some time one of the more acute sectors for labor tightness. So I think that's part of the reason as well. And the other thing is, I think that even though we're asking them to make a comparison, did something get better or worse, or did it increase or decrease over the last year? A lot of them are maybe thinking in terms of good, bad when they answer the question. And even if maybe the average number of applicants you get for an open position or the time to hire has come down a little bit, it's still a tough hiring environment. And I think overwhelmingly, that's probably what's on people's minds.
Sure. Thanks, Joe. And that will be our last question for today. Thanks so much for everyone for joining us. More information will be in our follow-up email to this event, and please join us for our next virtual event, the Regional Economic Conditions General Business, on Friday, February 23rd. And with that, I hope everyone has a great day.
Thank you.